It's actually better because of what we're seeing with oil prices. You know, the market doesn't want to see, or rather airline investors don't want to see cheap fuel. It leads to a breakdown in discipline. It leads to too much growth. It leads to, reckless competitive behavior. What we're seeing is that with oil prices rising, that contributes to our thesis that margins are actually set to expand next year for the first time in 4 years. So when you couple a strong economy, higher oil, lockdown labor costs, and tightening capacity, this is the best fundamental setup that I've seen since probably autumn of 2014.
So what I'm hearing from you is it's no longer wages, which used to be one of the most important issues with airlines. It's no longer fuel, which was the other most important issue. This is really about, I won't say monopoly, but something sort of like that, where you can get a real foothold and be dealing with less competition.
Yeah, that's right. I mean, fundamentally it comes down to supply, demand, fuel, and labor. And we feel exceedingly good about all four of those critical inputs. The other thing that we would point out, and you touched on this in your intro, the autumnal season is one in which, more often than not, airline equities outperform the market. Now, you can always go back and say, okay, if I bought low in the fall and sold high at the vernal, the vernal high, you would have outperformed. But even if you bought poorly in September or October, and sold poorly in April or May, chances are over the last 11 years, you'd outperform the S&P. So the calendar is on investors' side, and the fundamentals are exceedingly on investors' side at the moment.
When I look at your price targets, and these are price targets that you have in place, prices you're expecting these stocks to hit in the next 3 months by December of 2018, you're looking for some big jumps on Delta, American Airlines, and United. You have overweight on all three of those, but your price target, let's just say for Delta, $72 when the stock's trading at around $58, $59 now.
Look, we think that that equity prices right now are simply fundamentally mismatched with how strong the outlook for fundamentals are. We'll see if they achieve those targets. We have conviction that they can. But either way, we think now is an exceedingly strong time for investors to be looking at this space. Higher rates are reflective of a strong economy, but that strong economy has also helped us with oil prices.
Delta is actually trading at $52, so that's a $20 jump. You really think that's realistic?
We've seen those kind of equity gyrations in the past. Unfortunately, we've also seen it to the downside, but we think that the industry has, matured well past, those times when we would be, identifying that sort of downside risk. We think everything is skewed to the upside at this point.
As I said, you've got overweights on Delta, American Airlines, and United. What about Southwest? You've got a neutral there. Why is that?
Principally valuation. Southwest is always a very easy name, particularly for first-time investors to get comfortable with. But at this point, we don't see the sort of, glaring valuation deficiency the way that we see with the big three.
What would concern you? What would change your analysis of the sector overall?
Well, interestingly, fuel hedging, potentially could. Obviously, if the economy slows down or there's any sort of exogenous demand shock, but when you're living in a van down by the river, you need flood insurance. When you're on a mountain of liquidity, and an investment-grade balance sheet, we're talking about the airlines here, looking down and you can barely see the river, you don't need that sort of hedge insurance. We'd be very concerned if airlines began hedging again in response to higher fuel. Think back to the mid-year 2018, when in response to higher fuel, all of the airlines cut capacity. If somebody had had an advantageous hedge, structure in place at that time, they would have behaved differently, and that could have, come at the industry's disadvantage.